Welcome to Learning Upgraded, where we simplify complex topics for your learning journey. In our increasingly interconnected world, the ability to understand financial statements is more valuable than ever. These documents are like the pulse of a business, revealing its financial health and guiding future strategies. Whether you're looking to invest, start your own business, or simply want to better understand the economic world around you, this guide is your starting point. Today, we're diving into the world of financial statements, a crucial tool for understanding any business's financial health. Financial statements are like the health reports of a business. They provide a comprehensive picture of a company's financial condition, akin to a doctor's diagnostic report of a patient. Just as a health report reveals the state of a person's well-being, financial statements shed light on a company's performance, its financial strengths and weaknesses, and areas that need improvement. They are the lifeblood of any business, helping to track income and expenditures, measure profitability, and plan for the future. For investors, they offer invaluable insights into a company's financial stability, guiding investment decisions. For business owners, they serve as a roadmap, pointing out what's working and what's not, aiding strategic planning and decision-making. And if you're just curious about the inner workings of a business, well, financial statements are your go-to resource. They're the language of business, letting you in on the secrets of a company's financial health. Whether you're an investor, a business owner, or just curious about how businesses operate, understanding these documents is key. There are three main types of financial statements. First up, we have the balance sheet. This is like a business's snapshot, showing what it owns and what it owes at a specific point in time. Next, we have the income statement, which gives us a rundown of how much money a company has made and spent over a period of time. Lastly, we have the cash flow statement. This one's all about the movement of cash, showing how it flows in and out of a business. Let's start with the balance sheet. Think of it as a financial X-ray, revealing the business's economic backbone. It's a snapshot, a moment frozen in time, showing what a company owns and owes at a specific point. The balance sheet is divided into three main components. First up, we have assets. These are resources owned by the company that hold economic value. Assets can be tangible, like buildings and machinery, or intangible, like patents and trademarks. They also include cash and accounts receivable, which is money owed to the company by its customers. Next, we have liabilities. These are the company's financial obligations or debts. They include loans, accounts payable, which is money the company owes to its suppliers, and accrued expenses, like wages or taxes, that have been incurred but not yet paid. Finally, we arrive at shareholders' equity, often called net assets. This is the difference between assets and liabilities. It represents the residual interest in the assets of the company after deducting liabilities. In other words, if the company sold all its assets and paid off its debts, whatever is left would belong to the shareholders. So in essence, the balance sheet follows a simple equation. Assets equals liabilities plus shareholders' equity. And shareholders' equity, which is essentially the net worth of the company. It's the real deal, the bottom line. And that, folks, is the balance sheet in a nutshell. Next is the income statement. This important document is a record of a company's financial performance over a specific period of time, which could be a quarter, half year, or a full fiscal year. It provides a detailed look at how the company's revenues are transformed into net income or net profit. The income statement begins with revenue, also known as sales, which is the total amount of money generated by the sale of goods or services. This is the top line of the income statement and gives us the total resources available to the company before any costs or expenses are deducted. From the revenue, we subtract the cost of goods sold, which are the direct costs attributable to the production of the goods sold by the company. This gives us the gross profit, a preliminary, indirect measure of profitability. Next, we deduct operating expenses, which include salaries, rent, utilities, and other general and administrative expenses. These are the costs incurred in the day-to-day operations of the business. After subtracting these, we reach the operating profit, which shows how much the company earned from its core business operations. Finally, after accounting for interest and taxes, we arrive at the net income or net loss, also known as the bottom line. This is the company's total earnings, showing the amount of money that the company has earned or lost during the period, and ends with the net income, showing if the company made a profit or a loss. Lastly, the cash flow statement. This financial document is like the company's checkbook. It provides a detailed look at the cash coming in and going out of the business, painting a picture of how the company manages its cash resources. Unlike the income statement, which includes non-cash items like depreciation, the cash flow statement deals exclusively with actual cash transactions. Let's break it down. The cash flow statement is divided into 3 sections: operating activities, investing activities, and financing activities. Operating activities represent the core business operations. This includes cash received from customers, cash paid to suppliers, and cash paid for salaries. Essentially, it reflects how much cash the business generates from its products or services. Then we have investing activities. This section shows cash flow from the purchase and sale of assets, like equipment or buildings. If a company is investing heavily in its assets, it might be gearing up for growth. Finally, we come to financing activities. This section shows the cash flow from all financing activities, such as issuing stocks, bonds, or borrowing from a bank. It also includes paying dividends to shareholders. These activities essentially reflect how a company raises capital and returns it to shareholders. And that's the cash flow statement in a nutshell. It's a vital tool for understanding how a company generates, spends, and manages its cash. And financing activities, which include raising money or paying dividends. Understanding these financial statements gives you a comprehensive view of a company's financial health. We've journeyed through the balance sheet, income statement, and cash flow statement, each revealing unique aspects of a business. Keep exploring, and you'll be reading these statements like a pro in no time. Thank you for watching Learning Upgraded. We hope you found this guide helpful. Remember to like and subscribe for more simplified learning, and don't forget to hit the bell icon to stay updated. Keep learning, and see you in our next video.